What is up, everybody? Welcome back to Bitcoin and Markets. My name is Ansel Lindner. Today, we're doing something new. We're streaming to Kick. So if you're watching on Kick, if I get any viewers over there, welcome. I usually go live on YouTube, Telegram, have a community there. We talk about macro, geopolitics, Bitcoin, Federal Reserve, all sorts of stuff like that. And welcome to the show. Today, not a ton of news items to go over for Friday, but let me share my screen and we'll jump in. Wrong button there. First, of course, is the website, bitcoinandmarkets.com. Make myself a little bigger there. This one came out yesterday. I made it public this morning, actually. It went out to paid members on Thursday, and then today it went public for everybody. Common futurist fallacies. And I go through this independent disruption fallacy. Basically, it's one of the most common mistakes you'll see out there when you're thinking about technology in the future. It is the belief that new tools transform the economy on their own simply by being new and promising productivity gains. In this view, the health of the broader economy doesn't matter. Technology is expected to generate growth by itself. And I go through all of these reasons why it is flawed thinking. And of course, I apply it to artificial intelligence because I'm bearish on artificial intelligence. One of the main things is, as you see disruptive technology come in, it doesn't ever really completely kill the existing technology. So one of the examples, if you guys know that Based Camp, I think it's with the Collinses, Malcolm and Simone Collins. I catch their show about once a month or so, but they were talking about AI and how great AI is. And specifically, they were saying something about painting and how new technology replaces old technology. But, if you look up any information about portrait painting, okay, so portrait painting didn't vanish when the camera came around. There's more portrait painters today than there were when photography was invented. So everything like this, even theater, film, television, each iteration is supposed to be killing the previous ones. But in fact, there's more live theater goers today than there were, back before film. And so a lot of this stuff, it doesn't replace the technology. It layers on top of old technology. One of the better examples for replacement would be horses and cars. So I think there was something like 100 million horses in the United States around the turn of the 20th century, from 1800s to 1900s. And now it's down to like 5 million, but horses didn't go away. They went away a lot, but not completely, right? So that's still a layering effect, even when you have some sort of 95% replacement. Plus, bikes and planes and trains and cars and horses all coexist alongside of each other. So it's a complexity, it's a layering thing. So if that's the case, then to have disruptive technology, it expands the pie, right? And if we have a situation where the pie is shrinking, there's no room to layer complexity because the economy is shrinking. And so there won't be any disruptive technology. This is from a study here on economic complexity in the United States. And you can see the complexity goes up consistently as patents rise, as the population rises, as GDP goes up. Everything is going up together. And it's really hard to say, if GDP or population are shrinking, probably patents are going to be shrinking, and probably complexity is going to be shrinking as well. That means no room for disruptive layering of complexity. Okay. And then the second fallacy is a fertility fallacy. This is where it's a mistaken assumption that the economy can continue to grow at the rate it has over the past 2 centuries despite collapsing fertility rates. It misattributes extraordinary growth made possible by a unique demographic windfall to a natural law or progress of technology, governance, and capital. So if we wouldn't have had this big boost in population, most likely a lot of this technology would not have been possible. But anyway, I walked through that. You guys can check that out Let's see. When population turns negative, conclusion. Yeah. All right. That's at bitcoinandmarkets.com. Okay. Another story that came out today. And I'm going to share a different thing with you guys over there on Telegram because I always forget that I'm sharing the back end of the streaming. Okay. BOJ to unwind ETF holdings. This is very interesting. So a lot of people know that the Bank of Japan has been buying up all of the ETFs in Japan. It's something like 70% that they own. They of all ETFs in Japan, the Bank of Japan owes 70%. It's kind of crazy. But now they come out and said they're going to try to unwind this. And let's read a little bit from this Reuters article. So the Bank of Japan decided on Friday to start selling its holdings of risky assets. Two board members voted against. Okay, while the central bank kept short-term interest rates at 0.5%, board members, blah, 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 unsuccessfully, they wanted to hike them to 0.75. So they're trying still to hike rates. Crazy. The dissent from these guys highlights a growing hawkish pressure inside the BOJ. While the majority still favors a steady path, the presence of two board members voting against today's decision suggests the debate is tilting toward quicker normalization. I mean, I would have to ask Werner, what's his name? Is it Eric Werner? I'd have to ask him, is this real? Like, is this just kind of a play? They're very lockstep in their thinking over there, and to have two dissenting board members, is it just kind of, is it a signal in itself that they're trying to make, or what? Anyway, at the 2-day meeting ended Friday, BOJ decided to sell its holdings of exchange-traded funds in the market at an annual pace of around 330 billion yen. I heard that people timed this out or did the math on this, and this would take 100 years. So they're at a 100-year pace to get rid of all their ETFs. So very slow. It also decided to sell its REITs at an annual pace of around 5 billion yen. BOJ said it would start selling once necessary operational preparations are completed and could review the pace of selling in future policy meetings. While the BOJ was widely expected to unwind its ETF holdings eventually, the announcement came much sooner than the market was predicting. The decision to unload ETFs pushed down the benchmark Nikkei from its record high, while the yen and short-term bond yields surged on the hawkish board dissent. The BOJ's hawkish tilt contrasted with the U.S. Federal Reserve's decision on Wednesday to cut interest rates. Okay. Political headwinds. While some analysts see the hawkish dissent as heightening the chance of a rate hike in October, others see political uncertainty caused by the prime minister's decision to step down, casting doubt over such a move. The ruling party is gearing up for a leadership race on October 4th to choose Ishiba's successor. All right, let's see. The BOJ exited a massive decade-long stimulus program last year and raised short-term rates to 0.5% in January. On the view, Japan was on the cusp of sustainably achieving its 2% inflation target. Japan's consumer prices rose 2.7% in the year to August. I guess they mean the 12 months up to August. Data showed on Friday, showing that the third straight month, but staying above the central bank's 2% target. Okay, great. That's one of the bigger stories out there. You can tell there's not much going on macro-wise today. So let's go to the reaction video. So this is Mel Mattison on with Marty Bent, and somebody from the community, Clarkian, sent this in and asked me what I thought about this, and I've never heard of Mattison before, so we're going to listen to this episode. I have listened to the first 10 minutes or so, and he's sounding very, very good, very similar to my outlook on things. I have been very bullish on the United States for a long, long time, going back probably at least 4 years, maybe even 6 years before COVID. I can't remember exactly, but very bullish on the United States relative to the other economies in the world. And my pre-recession trade that I've been talking about for years is bonds up, dollar up, Bitcoin up, stocks up, oil down. And that's pretty much what has been occurring. So let's get into Mel's stuff here. Let me see if there's any comments. All right. Guys, if you're watching on YouTube or Kick, you can make a comment. I'm not sure how I see myself streaming live. Let me go. This is my first time streaming on Kick, so let's see. Let's see how it is. Okay. Don't want to listen to my. Sorry about this. All right. No. Do I have to close down the damn window? Sorry. That's what I did. We're streaming on Kick. I can't listen to myself on feedback. Okay. Let's go back to this video and we'll start it. Again, guys, give it a watch. Liking it right now. Make sure you guys like it as well. And let's go.
But summer's over. Summer doldrum's over. Jackson Hole's over. We caught up, I believe in July or late June. And when we last caught up, we said, hey, let's catch up. After Labor Day, here we are, 3 days after Labor Day. And it seems like the world is not any less chaotic than it was the last time we talked. Maybe in a good way. You've got a lot of thoughts about what's going on.
Well, I do remember the last time we talked. Let me just check right now. It's funny because closing words were, I'm optimistic. There's a lot of stuff going on. There's going to be ups and downs. But when we talk 3 months later, we're going to have like S&P 100 somewhere around 63, 6,400. And here we are, S&P 6448. So, I mean, it's like there's so much noise right now. But like when you step back, there are these major trends, like whether it's fiat debasement, whatever it is, that are just in place. And people are really going nuts about different things, or Fed independence, or long ends are crashing, and all this stuff. And it's like at the end of the day, I'll make the prediction again right now. In 3 months from now, we'll come back and it'll be, Bitcoin will be like, have hit 140, and, SPX will be at 6,800. And, like these longer term trends are going on, and there's so much.
3 months, Bitcoin will be at 140 by the end of the year. I mean, it's very possible. Everyone's kind of waiting for October to come. 150 is the obvious next target. And can it reach 200 by the end of the year? I mean, anything's possible, but we've been just stuck in in such a slow period here for the last 9 months. I mean, since December, it hit 108 in December, and now we're still at 115. So it's been very, very slow. And maybe October, November, December are going to be big like last year, but we'll have to wait
noise, which is interesting, and you can profit from it. But at the end of the day, I think there's just this general fiat debate trade in place, which is long gold, long Bitcoin, beneficial for equities. I think the new Fed dynamic that's going on is actually bullish bonds, which is a little anti-consensus right now. And I think that, we've got a president and an administration that is hell-bent on creating.
Is definitely bullish bonds. The Fed's cutting rates. It's bullish for bonds for sure. We already had a bull steepening, or we are in the midst of a bull steepening right now. And the next step is for the bottom to fall out of the yields. So 100%, man. He's right on cue with my calls, probably for different reasons. But
an economic boom, come hell or high water. He wants housing to soar. He wants lower rates. He wants higher equities. And he is going to push, push, push. And I think a lot of people are, raising their hands in the air saying this is all going to collapse. And I'm not saying that's not impossible, but my bet is that it's actually going to happen. and that, a year from now, we're going to be at an S&P over 7,000. We're going to be at Bitcoin over 150. We're going to be at gold over 4,000. We're going to have a 10-year with a 3 handle on it. And the economy is going to be booming. And that's what I see coming. And we can get into all of the details of how that works out and all the intrigues. And I'm just really excited to be here and talk about it with you because I love our conversations. And
the only thing I have to add to that is the oil. My call on oil is for oil to slowly go down over time because demographics, the economy, as far as the eye can see, there's no real huge spike in demand that's coming. So, and the supply every year, break evens go a little bit lower, and keep finding more oil reserves everywhere in the world. And OPEC is bringing back their production from, they're lowering their cutbacks. So they're coming out is about, I think they're 100,000 barrels per day increase every month. So yeah, there's more supply coming out that's cheaper, and the demand side is not looking good. So oil would be the only thing that I would add to his little list there.
And that's generally where I see things going. So short term, there's going to be bumps in the road, but long term, I think the trends continue.
Well, I guess let's break it down piece by piece, starting with the Fed. As I mentioned earlier, we had Jackson Hole a couple of weeks ago. I think it was time seeing some dovish comments come out of Jerome Powell's mouth, really moving from focusing on inflation to focusing on the jobs market. At the same time, in parallel behind the scenes, you have Trump firing a Fed governor because of some mortgage fraud that may have been going on. And I think the thesis that you laid out in December of last year, when we did predictions for 20,
may have been going on. She never denied it. She never denied that she committed fraud at all. Even in her court filings, all she said was Trump did not have the power to do this when he plainly has the power to do it. She's gone.
25, one of which was that you're going to see this sort of merging of the Treasury and the Fed. And it seems like the moves have been made, particularly the saber rattling with Jerome Powell.
I talked about this on the stream on Wednesday. The independence of the Fed is going away. I mean, the writing is on the wall, whether it's this year, next year, 4 years from now, 8 years from now, the writing is on the wall. The Fed's independence is done for. They have no credibility. Powell is right now committing malfeasance where he's not firing Lisa Cook. So with a lawful order of the President of the United States. So this is malfeasance that he could be fired for. And just looking down the road, the writing's on the wall for the Fed. They're losing their independence. Whether it'll go away completely, I don't know. Maybe that'll take another 10, 20 years, but maybe it eventually goes away. We'll see.
And Donald Trump and then Trump firing this Fed governor is signaling that this may be happening in real time.
Yeah, exactly. And I think, on net, if you look at the history of the United States, for the most part, we have not had an independent central bank. It's kind of an anomaly. And multiple times in the 20th century, we didn't have an independent central bank. For most of the 19th century, the 1800s, we did not have a central bank at all. So I think people really need to just chill out about this whole Fed thing. Like, it reminds me of almost talking about Jerome Powell like a pope, or what I really think he is he's more of a Wizard of Oz character. And the Wizard of Oz is an amazing allegory. I mean, the yellow brick road is the gold standard. In the book, Dorothy doesn't have ruby slippers, she has silver slippers, and the silver slippers get her home. The modern day equivalent might be Bitcoin. I mean, if L. Frank Baum was writing The Wizard of Oz now, Dorothy would be wearing orange slippers. No doubt about it. That she thinks, and it wouldn't be a yellow brick road. She'd be following like the emerald brick road, the dollar, and then she'd get to Oz, and then she'd find out that Jerome Powell and the Federal Reserve governors are all a bunch of crooks behind the curtain. And I'm not saying Powell's a crook. I mean, don't get me wrong. I'm not trying to impugn anyone's character. But what I am saying is that there is a massive political, either conscious or unconscious, bias within the Fed. It is an inherently political organization in the same way that the Supreme Court is an inherently political organization because they are all political appointees. I mean, if you take a bunch of politicians and you have them appoint people into important positions,
Well, guys, the way I look at it is the bankers are a faction in society. So you have the people, the bankers, and the Marxists or the bureaucrats, the bureaucratic class, the aristocracy. Okay, so you have the people, the aristocracy or the bureaucrats, and the bankers. Those are the three factions in society, and so they are. It's not inherently political. I mean, I guess it's inherently political if you say that's the banking faction, but it's not inherently political because the way they appoint people. The bankers tell you who to put up. It's not like it's not like Trump knew Powell personally and he had a great relationship with him, and then that's who he nominated to be the Fed chairman, because he was initially nominated by Trump. No, the bankers came to Trump and said, "Hey, this is who we want you to put in there," and he said, "Okay." So it's not. I don't know. But I mean, he's making.
I
good
mean, it's
points.
almost like a transformative law of like geometric, doing proofs, like, like you're going to get politics. And I could guarantee you that if we were in this situation and the data was coming in the way it was and Kamala Harris was president, I can guarantee you Lisa Cook would be voting for cuts. There's no question in my mind. And so there is an inherent bias in the Fed. It's never been independent. It never will be independent. It is under the control ultimately of the Treasury. It always has been. Whenever the U.S. government needs to do something on monetary policy, they tell the Fed what to do, and the Fed does it. This happened in World War II. It happened in the 50s. It's just the way it works. The central bank is a servant of the government. It was created in 1694. William III, Bank of England, we're going to fund a war with France. It's there to serve the sovereign. That's what it's there for. And at the end of the day, I don't care if it's AOC or JD Vance as president in 2029, they're going to keep pushing rates lower. Elizabeth Warren was writing letters to Jerome Powell last year saying, you must lower. This is not political. This isn't about Trump. This is about the U.S. fiscal situation. We cannot afford to keep rates this high. Our interest expense is blowing up. We were at 132% debt to GDP in 2020.
Okay, I disagree with this. We can finance the U.S. government can finance itself. Remember, guys, that the interest rate cost for the government is income for the people, right? Somebody is owning those, and somebody's getting that interest rate. That's income. So 5% income. The interest expense, you can just look at it as a stimulus to income investors. It's not a drag, because there is, if it were a drag, well, I guess the cure for high rates is high rates, because they'll eventually start coming back down. But there is effectively infinite demand for treasuries, and so yeah, the way that they should push up yields is they should issue a whole crap load of debt, and then, I mean, a lot, not just what they did in COVID, which was what, like 9 trillion. No, they should go for 50 trillion. Then yields would go way high, and then they could take that 50 trillion and buy assets with it or something like that, like Trump wants to make that sovereign wealth fund or something. No, there's no threat at all of any sort of problem with the financing of the government. We are so far away from that. I mean, maybe in 10 years we can look at it and say, okay, maybe now people are starting to lose appetite for it. But long before that, the incentives are going to be there to fix it, to back it by Bitcoin or something like that. So I would not be worried anything in that regard. Also, he's saying here that it's always been inherently political. I disagree. I see that maybe when times are tough, like the examples that he used were war, really, really emergency measure crisis times. Okay, I can go with that there is less independence in these crisis times. But 98% of the time, it has been effectively independent. I mean, the bankers fund the politicians too, right? And so who's really in charge? Why is Elizabeth Warren writing these letters to the Federal Reserve? Well, because her banker buddies are telling her to do that. The lobbyists. And so who's independent? Is the Congress fully independent of the bankers? Hey, no. So it goes both ways. But if you take a net total, I would say has been 99% or 98% of the time, we'll say, has been generally independent. Okay.
Money. And our interest expense as a percent of GDP was 1.49%. We reduced our debt to GDP after the COVID GDP drop ended to 120%. So we dropped debt to GDP by 12%, and interest expense as a percent of GDP more than doubled from 1.49% to over 3%. In other words, we're raising these interest rates. We have so much debt.
Don't call it interest expense, call it interest income, because that is someone's
And
income.
this is not only for the United States. This is for Europe. This is for Japan. This is what you're seeing in England. And all of these central bankers, they're going to get together in Basel, Switzerland at the Bank for International Settlements every 2 months, like they always do. And they're going to say, we need to keep rates lower for longer. And the bond market is starting to sniff that out. And I think we recently had perhaps a peak in the long end for especially the US and maybe, gilts and booms. But I think interest rates are going down. And like I said, I think we're going to see a 3 handle on the 10-year, if not by the end of the year, early next year. And we're going to have gold up, Bitcoin up, stock market up, bonds up. Like, I'm bullish everything.
Well, I think particularly as it pertains to treasury yields, that is a bit contrarian, but we were chatting for a bit before we hit record. And I guess let's just dive into the long end of the yield curve. I'll pull up the 10-year yield, the 30-year yield, and then the chart that you're focused on right now, which is the December futures contract for the 30 years. So as you can see here, getting a 2025 10-year began the year around 4.8. So currently at 4.19. Got the 30-year. The way this is sharing is a bit awkward, but if we go to the 30-year, we'll see it's right at 4.87 right now, peaked at 5.09 in May of this year. And then here's the chart that you really want to look at, which is the December futures contract for the 30-year. And you're saying that despite the yield curve of the 30-year, the futures contract is really where the signal is.
Yeah. So for people that don't, trade bonds, right? I don't want to insult any listeners that this is like 101, but there might be some people listening that don't understand this. So when bonds rally, what we mean is their price goes up, which actually means the yield goes down. So that can be a little confusing. So you have to kind of wrap your head around that. So if yields go up, price goes down. And the way most people that are active in trading make bets on the bond market is they do it through futures contracts. And this contract here is ZBZ25. ZB, that means long bond. Z stands for December. That's the month for expiration, 25 the year. So this is basically the it's not necessarily the front month, but it's the active month. So futures traders tend to pick a contract, and then that's the one that's active, and that's where the volume is and liquidity. So right now, if you're a trader and you're trading the long end of US bonds, you're trading ZBZ25. And if you look at this chart, it is up and to the right. It's got higher highs and higher lows. And this goes back to May, right? So as you might remember, in the beginning of the year, there was this other big freak out, and the US was going to have a Liz Truss moment. At that point in time, this was not the front month contract, but people were already trading the December contract. And that was when they took this down below 110 to like 109. And it's currently at 114.27 on my charts. I just looked to the right of mine. So we've basically gone up, call it 4 or 5%. In bonds, that's not bad, but it's up. Again, it's up and to the right. It's a bullish chart. And so if you look at absolute yields and you say, oh, well, absolute yields, we're approaching the highs around 5. Yes, that's true. But if you look at the way practitioners playing the long bond trade it, it's actually the lows were all the way back in May. And then we hit a low in July. And then if you actually drew that line you drew, Marty, based on kind of closing prices instead of intra, I mean, you'd see like we touched it to the perfection, right? Like it basically, we tapped right down to where look at that. Yeah. Go down a little bit more. Yeah. Like it runs right through those closes, which are, where those sideways lines are. So like on Tuesday, when everybody was flipping out, I literally was on Twitter and I was buying TLT calls for like 11 cents, 86 calls. I bought like 100 in an account. I forgot I bought about it. I forgot I bought it. And, I spent like $1,000. For me, that's not a big play. I'm like, okay, I'm gonna put 1,000 bet down on 186 TLT calls for yesterday expiry. They were up 700% yesterday. I mean, like it was literally like, and I had forgotten about it. And then because I trade a lot of accounts, and I went into this account. I'm like, oh my God, why is this account up so much? And I'm like, oh yeah, I'm up $5,000 on my TLT calls that I bet $1,000 on yesterday. And it's like people were flipping out about bonds, and I'm like, this is a bullish chart. This is an up and to the right chart. And Lisa Abramowitz and all these people on Bloomberg, they're like, oh my God, and yields are collapsing. And I'm just so sick of these talking heads on TV getting everything wrong. Tariffs are going to collapse the stock market. Inflation is going to go out of control. And the latest thing that I think is starting to fall apart is these people have been pushing this narrative that there's no problems in the job market. So this could be a whole nother switch into a different topic. I think there are issues in the job market. I think that the job market is weaker than people.
Okay, he didn't really explain a lot why he thinks, or why the yields are doing what they're doing. So let me see if I can I do it with a easy chart here? So when you think of the different maturities, okay, from the 4-week all the way up to the 30-year for the Treasury securities, these things are held. So he's talking about the trading of these things, but these things are held for different reasons, okay, and they have different liquidities. So when shit hits the fan, like it did in the repo rumble in 2019, in the great financial crisis, in COVID, when shit hits the fan, what happens is people run to the short end of the curve. And what happens when they run to the short end of the curve? The short end collapses. The yields collapse. Nothing much happens to the long end. Perhaps the long end even goes up a little bit, right? Because people are moving away from the long end into the short end because they have different liquidity characteristics. And so you'll see a massive drop in the short end, very little volatility, maybe a little bit up in the long end, but then eventually everything goes down, because the reason why those investors are moving over to the short end is because shit is hitting the fan. Once that sinks in, and there's a couple days, maybe even out to a couple months, reality starts setting in, and there's way more demand that goes into treasuries overall. Money will come out of the stock market and go into treasuries. That's why, like in a recession, you see stocks by the end of recession, or actually stocks will sell off at the beginning of a recession and come, hit bottom about halfway through and come back up in the second half of a recession. So the reason why that happens is because they're selling their stocks and they're going into bonds. And so that's why the bond yields go down. They're the safest and most liquid assets. Right now, I think gold is taking some of that bid, and Bitcoin will. It's been very frustrating this entire calendar year that Bitcoin has not gotten any of this bid yet. But looking at these yields, like if we bring the 10-year up, the 10-year is just slightly down from its highs in January. So the bid hasn't really even started to roll through. But once we start getting down now to these lower levels, it becomes much more obvious that the short end is starting to get the bid. Okay, here's the 1 year, 6 month. Look at the 6 month action here. If we bring up the Treasury, the Fed funds, this is the new bottom, 4%. And look where the 6 month is. The 6 months all the way down at 3.85%. So money is already starting to go into the short end. And this is we were talking about the 3-month for a long time. The 3-month also, money started going in there because people are worried. Why does the Fed cut rates? Why does the Fed cut rates? It cuts rates because there's problems in the economy. So for the very reason why they cut rates is telegraphing to the rest of the market something is wrong. And so money is going to flow into more safe and liquid assets, and the short end is more safe and more liquid than the long end. So that's why this is happening. But I agree overall with his take that yields will be lower. I've been saying that for a very long time.
Realize, and this is a big deal. And I think that we are literally not just going to get 5 or 6 cuts. I think we could get as many as 10 cuts in the next 12 months.
Would that be 10, 25 basis point cuts? So down 2.5%, down to around 2%?
Yeah.
FFR?
Yeah.
I'm pulling it up. I'm trying to pull it up right now. But
I agree.
Initial jobs claims. Jobless claims came out today, 237,000.
And they're going to cut by a lot, not 25 basis points. If you go back in history and you look at, other times when they started cutting, they might have started cutting relatively easy, 25 basis points. Then all of a sudden they have an emergency meeting and they cut 100 basis points. History is going to repeat itself. The same thing is going to happen over and over again.
Was the print expected was 230, so more initial jobless claims than expected. Continuing claims a bit lower than expected, but what was the other? 80 private payrolls. I think this is the big one, the big miss that people were looking at. 4,000 was print, expect 1,106K. So I think this ADP private payrolls is probably more signal that takes out the government jobs. Is well below expectations and well below the last print.
Yeah.
This is before revisions.
And yesterday, what helped drive that bond move, I think a lot of it was technicals. I think we were going to bounce on the long end anyways. But a big driver of that move yesterday was the JOLTS report, which showed that for the first time in the last 4 years, there are more people seeking a job than there are jobs. So if people remember, like there was a point during the pandemic, the Great Resignation, people could leave, get a job next week, 20% more. That's gone now. We were at one point, I think like 2.5 times job openings relative to unemployed. Look, there's a table that I'm going to be watching very carefully in the next unemployment report, which comes out this Friday. It's table A7 in the BLS report. It breaks down foreign-born versus native-born workers. And this has nothing to do with politics or anything like that. I just personally believe that there, on the foreign-born side, there's a lot of noise right now, which is a lot of people who are pouring across the border, filling those types of jobs that foreign-born do. We're flooding the market, had a relatively high unemployment rate of foreign-born. And this is how the BLS breaks it down. If nobody's ever looked up the PDF report that the BLS puts out, it's called the Employment Situation Report. They have a table A7, and it doesn't break down illegal versus legal or is there anything like that. It breaks down foreign-born versus native-born. If you look at foreign-born.
Yeah, but they're not counting the illegals. How would they do that? How would they count, how many illegals are in the Home Depot parking lots? No, they're counting legal foreign-born. Legal foreign-born that's what they're counting.
Because the border's been closed, the unemployment rate has been born. If you look at native-born, the unemployment rate has been really going up. And those two have been canceling themselves out. And so what you're seeing when they
it's not because of the border closing. It's because of the getting rid of some of the H-1Bs, getting rid of some of the visas, people here on visas. Also, perhaps people just choosing to leave. They see the writing on the wall. They choose to leave. But it's not because of the border, because they're not counting illegals.
The overall unemployment rate is 4.2.
I could be wrong on that. You guys can check me, fact check me, but I'm pretty sure that they don't count illegals.
Pay no attention to the man behind the curtain. There's nothing to see here. But the truth of the matter is that I think looking at the native born, is the way to look at it because it cancels out all the noise in the foreign born. It takes away the noise that's going on with visas. It takes away the noise with immigration. If
I agree with that.
you want to read on what's the real unemployment report rate on Friday, go to the BLS, pull up the report, scroll down to table A7, look at the native born unemployment and see what's happening. And it's going up. It was like 3.8 or something like that, 3.7, a year or two ago. And now it's like 4.8. Like it's going up significantly. And we're seeing young people having a harder time get a job. And where we're really seeing the unemployment, because they also break down foreign born, native born, and then they do men versus women. And I love to focus on native born women because they tend to be more college educated. They tend to be more in non-manufacturing, non-construction. So they're a better read on the white collar. They're the unemployment rate of native born women is skyrocketing in this country. And so what that's telling me, and you see it in anecdotal data about layoffs and everything else and AI efficiencies. Jordy Visser does a great job showing like Mag 7 is like growing revenues and earnings like crazy and they're not adding any headcount. Like we have so many deflationary forces going on right now that I think eventually once Trump gets his Fed board in place, like I said, 8 to 10 cuts in the next 12 months. I mean, I don't think anybody's saying that, but I pride myself on making outrageous calls that come true. Like in December saying emerging markets were going to crush, SPY, EM was going to crush SPY. Right now, SPY's up about 10%. Emerging markets are up over 20. I called for a 15-20% crash in the first half of the year. That was going to have a quick rebound to 7,000. I called for the DXY to crash below 100 very quick. I mean, every call I've made, and I made this kind of tongue-in-cheek post on Twitter the other day, calling myself the GOAT. Like I'm the best. I'm the best macro strategist on Twitter. It was a total kind of joke, but the point was to say, look, like some of these calls are really dang good, and not many people know me because I didn't do anything until like a year ago when my book got published. So I'm kind of out of nowhere. I don't have like a 10-year history. I was never on social media my whole life. I never had a Facebook account, Twitter account. I mean, I actually hated social media. I didn't want to be a part of it.
Well, yeah, I mean, okay, his calls have been great. I wonder what his macro framework is, because if he's just going off of feel and looking at different statistics like the BLS, the native born women, and all this stuff, yeah, he's going to have a string probably of really good calls. But depending on your macro thesis, he's calling for 8 cuts. 2.5%, I think, is legit, but I don't think it will come in 8 individual cuts. It's going to come in like maybe 5 individual cuts, maybe 4, because they're going to slash it by 100 basis points. Anyway, so yeah, he's made some good calls, but he'll eventually start hitting a cold period, cold stretch. That's the word I was looking for. If he doesn't have a macro thesis, and so far I haven't heard any macro thesis. I've just heard like looking at the chart, saying it's higher lows and that kind of thing. So I want to see his fundamental analysis to go along with his chart stuff.
It was like not part of my ethos. So I was almost, and then I wrote a book and my publisher's like, you should get on social media. And now I love coming on podcasts like this and sharing my views. But I don't have a research firm. I don't have clients. I'm an investor. Like I invest my own capital that I earned throughout my career being a fintech executive. I'm doing very well. And I like to share my views and help people. And I'll tell you, some of these calls are really good. And what hurts me a lot is like, there's just this consensus out there that has been leading people astray, telling people markets are collapsing, bonds are collapsing. The truth of the matter is we've been in one of the greatest investment.
100%. There's so many chicken littles out there. And of course I point them out. Luke Groman, sometimes George Gammon, just the Austrian side of the house. Most Bitcoiners, they're inflationistas. They can't look at the market and see it for what it is because they have a bias. They have a bias that the dollar is collapsing, that the Fed failing is interest rates going up, when in fact the Fed failing is interest rates going down. Deflation is the Fed failing, and not just prices going down. People say, oh, what deflation is good. Not hyper deflation, not actual deflation where the money supply is shrinking. Deflation like price deflation. Okay, I can go with you as long as it's not hyper deflation. I mean, hyper deflation looks like a stock market crash. Your dollar goes further because stuff is crashing in value. That's not a good situation to be in. Remember that I talk about it every once in a while, that line from The Big Short, where Brad Pitt's character, they're jumping for joy that their investment made them, I don't know, hundreds of millions of dollars. They're jumping for joy in the casino, and Brad Pitt's character turns around and says, "Don't dance." Did you know that for every percent that the unemployment rate goes up, 40,000 people die or something, he said? And they said, "No, we didn't know that." He's like, "Yeah, you can be happy, but just don't dance." So yeah, when you're talking about crashing and hyper deflation periods, nobody wants that. Nobody wants that. And I think that the last couple years have been really good for investments and have been bullish for the US. And I've been calling them too, the same way, not to the dollar or whatever he said about the S&P 500 would be at 6,400 or whatever. But the directionally, I have been correct, and that's because of a macro thesis. So I want some more from him. What is his macro thesis here?
Environments in my lifetime, and a lot of people have been scared because people feed a bunch of doom and gloom bullshit.
Sup, freaks? This rip of TFTC was brought to you by our good friends at BitKey. BitKey makes Bitcoin.
And it's easy to see how we touched on this last time we talked to it, because you have what's happening in financial markets and you have the real economy. And as you it seems like many people are hurting. I mean, I'm sure you've seen it, the memes of, not only the memes, TikTok videos of people in their car complaining about grocery bills. I think millennials, younger millennials, Gen Z, coming to the realization that real estate may be running away from them. And I think a lot.
Okay, I had another thought. So Mel is saying like bond prices going up is bullish. No, it's not. It's bearish. That was my point, is that when you see yields going down, that's very, very bearish. That means people are flowing into safe and liquid assets. The Fed cuts rates, not to stimulate. They do it to have accommodative monetary policy. But the reason why they have to do it is because shit's hitting the fan. Okay. And so, yeah, it can be great that, and stocks go up in this period because people are not investing in their business. People are not taking, adding a new line to their factory or buying a new trucks for their fleet. Instead, they're investing, they're putting it away. And individuals and businesses, all of that, everything is slowing down and they're putting it into investments. And where do most people invest money? Is into the stock market. So that's why the stocks go up as well. So everything looks like it's going up. And that looks very bullish. Looks like we're growing. Looks like that's all green flags. But really, it's not, because the everything goes up right before it starts going down. And like the way that we would know everything going up would be good, because there is a situation where there's high growth. Let's say we go back to the 80s and you have 8% growth rates. Okay. You can tell it's healthy because the yield curve is healthy, because it's upward sloping. But when there's an inversion in the yields, it tells you that this isn't real growth. Okay. This is building up to something else. It's not bullish in itself. It's actually, the growth is bearish because of the yield curve is inverted. And if you look at the yield curve right now, the 4-week out to the 10-year is pretty flat. Let me look at that, what that is. So the 4-week is at 4.1. Okay. And the 10-year is at 4.12. So from the 4-week out to the 10-year, it is flat. It's only when you get up there to the 20 and the 30 that you see an upward shape. But then you look at the 2-year. Let's see which is the lowest. The 2-year, that's the major one that's lowest. The 3-year is actually slightly lower, but that's not a major one. So the 2-year is at 3.57. It's is that 50 bips? Yeah, it's 50 bips lower than the 10-year. See how that's inverted? So we know that this isn't sustainable bullish growth. This is just a blow off towards a crash. And when that crash comes, I don't know. They can push it out a long time. It's been going on years now at this point. But we know that it's coming because of the inversions on the yield curve. All right. Play.
A lot of those the anecdotal data points really drive this dread, and then the overarching emergence of AI really becoming fearful that it's coming for their jobs. But you mentioned Jordy Visser quite on the show a couple months ago too, and I think that we just have to, as individuals, as a society, as an economy, is that we are living through this incredible inflection point in many different ways with the multipolar world becoming more multipolar. You have the debt crisis here, or the debt situation here in the United States, geopolitical strife globally with wars and all that. And then you throw AI in the mix. I think people are just completely uncertain about what's going to happen in the future, particularly with their jobs. And so I guess they have this perceived fear that I'm going to lose my job and I'm not going to have the ability to buy a house that the market has to tank.
No, I mean, there's some people talk about the fourth turning. People talk about inflection points. I mean, we're there. I mean, look, in the 1860s, you had a run up in essentially wealth inequality, and you get these situations periodically throughout history. And frankly, the way a lot of it gets resolved is you cut down on resource demand by killing people.
Yep.
Right. So you have a massive war in Europe and you kill tens of millions of people. All of a sudden, that intense competition for resources gets a lot easier. Right. So
well, not just that, but you also can have a reduction in your standard of living across the board, so that the bottom 50% start going without, and then you have this higher wealth inequality. I mean, it's not good. It's not good. And especially when now I wonder if he's going to talk about this. I should just let it play. But the demographics. So if we're coming up to one of these inflection points, in the past, we could always rely, at least the last 200, 250 years, we could always rely on a bounce back with a higher population. So yeah, a lot of people were killed in a war maybe, but in the grand scheme of things, if you look at global populations and you look at like the Civil War, there wasn't even barely a blip, and that was our bloodiest war. So World War I, World War II, the U.S. compared to the rest of the world really didn't have a blip at all. But these demographics are a wave. They're a slow-moving wave, and there's going to be no demand to bring us back from any sort of collapse, which is kind of scary to think about.
This is not what we want to head into. We don't want to have a situation where just this week we had Xi meeting with Putin, meeting with Kim Jong-un, in China, and Modi with India. Like we don't want to go down that path. Like we've done it too many times as a species, where you get one side, you get the other side, they start getting competitive, and then the resolution is essentially everybody goes batshit crazy and starts killing each other. Like that's not a good outcome, right? And so I think it's important to talk about it. And I think social media, I think shows like this, I think like the population, like it's educated, it's global. And I think we have a shot of actually avoiding World War III. I think some people are like, oh, this is inevitable. We're going to have like a BRICS side begin to build up, and it's going to be, the cornerstone will be Russia, India, China, and then there'll be the US.
Well, it could look a lot different than you expect. I mean, nuclear weapons kind of put a kibosh on all-out total war. Right. So are we in fifth generation warfare right now? Is a lot of the stuff we're seeing part of the war? Are we in a war right now? So, yeah, we'll have World War III. And if when historians look back on this period, they'll be like, this is when World War III happened. But it's not going to be a global total war. We have nuclear weapons. All right.
Eventually, Western Europe will come onto our side because they realize that's what they need to be. We hope that's not the case, because in history, it's surprising how stuff actually is completely clear to everybody. Like in the 1930s, it was very clear Japan was building up their military empire. Germany was building up. Like it was very clear, like we were getting ready to head towards something, and then we went over the cliff. And I think right now we're in a similar situation where like China's building all these ships and new submarines and there's these new alliances. And it's like, look, guys, open your eyes. We're heading towards something here, which is not a pretty picture. So let's figure out a way not to kill each other. You know what I mean?
Yeah,
I don't think that's
completely
gonna
know what you
happen.
mean. That's why I wanted to bring this up. Outside of the military parade that happened earlier this week, I think, obviously you have the geopolitics and the kinetic side of things, but then going back to the monetary, that's why, as you're describing that, I wanted to bring up this chart, which is what I read about last night in my newsletter, and I hadn't seen this chart until yesterday. It sort of blew my mind. And so what we're looking at is the stock level of gold in China on warrant. For those who are unfamiliar what it means to be on warrant, essentially the PBOC, or banks at the behest of the CCP, financial institutions at the behest of the CCP, have gone to the Shanghai gold vaults and basically registered their gold at the Shanghai Gold Exchange, be used as collateral or to provide liquidity to gold markets to make the Shanghai Gold Exchange more prominent in gold markets. And I'm looking at this saying they're definitely prepping for something. There's been these, we've all known, I've written about it. I think people have been observing it for the last 15 years. China's certainly been building up gold inventories at the PBOC. And I think what we're seeing now is they're actually putting those inventories to work by registering them at the Shanghai Gold Exchange.
Well, here's
You guys probably know my take on this. It's they're selling U.S. Treasuries as well. They're putting their gold on warrant. That's a bad sign. That's not a sign of a functioning, a sign of a good growing economy would be taking more gold off of warrant, putting more gold in their central bank, not using it in the market. So, I mean, maybe they have some ideas, but really, I just think this is a bearish sign for China. Same as selling of U.S. Treasuries. You don't want to sell your U.S. Treasuries. Nobody wants to sell U.S. Treasuries. They want more. That means they're getting illiquid if they're doing that. They want more liquidity. They want more U.S. Treasuries. Nobody wants a yuan. Nobody wants the yuan or any yuan denominated debt. It's ridiculous to even think that. Anyway, you guys know I'm very bearish on China, bullish on the U.S.
And forgive me for 1 second, but we have done so many, never been a shameless promoter of my book Quaz, but this is so apropos. So what you're showing there is you're showing like around 2,500 kilograms up to like 30 plus, right? In gold. In Quaz, this is like part 1 of the book, All That Glitters. I have an introduction. And this is what it says. According to official statistics, the largest holder of gold in the world is the United States at over 8,000 metric tons. However, according to unofficial calculation, China holds not the 2,000 tons publicly reported, but closer to 32,000 tons. As of 2007, China has replaced South Africa as the world's largest producer of gold. I wrote that in 2023. This was out there in gold circles. People knew that China had so much more gold than they were reporting, and they're using the Shanghai Exchange. This is what's going on. Like China, the BRICS. I mean, they've obviously decided that holding U.S. Treasuries is not where they want to be. Now, I want to counter this because the narrative is like, oh my God, China doesn't want to have treasuries. That's a big problem. It's not.
Let's go back. So notice on the chart, 2020, like it had a baseline for a long time. And then 2020, it started going up. And it never came back down to this lower baseline. So this is registering of zero COVID policies. This is registering of bad financial times. I bet if you look at this spike, this probably has something to do with one of their big real estate companies going insolvent. So when this goes up, this is probably a bad sign, I would say, because it started going up in COVID, and now it's really going off the rails. And, they've done 2 big bazookas, financial bazookas. It could also be that they're putting their gold there to manage their own currency relative to gold because they've already done capital controls, but they have done all this bazooka stimulus, and they're threatening to do a third, or they're going to do a third, and maybe they're starting to lose control a little bit. I mean, if you look at their 10-year yield, I'll bring that up on the screen here just a sec. Remember, I said that falling rates is the central bank losing, right? And look at their 10-year. I mean, this is a daily. Let's go to weekly. Oh, no, this isn't 10-year. Do I have it on the list? No, I have to type it in. Hold on one second. There we go. This is their 10-year. Look what happened. And also, if you go to this section and then we go back to his chart. Okay, so this really started blowing up in, looks like maybe first quarter of 2024, because this is a 2-year mark. So maybe let's just say around April of 2024. Okay. Now, if we go back to the 10-year, what's going on? April of 2024. We get this sharp little move here. I mean, nothing significant, but it's going down, and then here the wheels just fall off. Okay. So this is really bad. This is telling you that there's something major wrong with their economy if their 10-year is 65. Not a good look. Okay.
Exchange. This is what's going on. Like China, the previously decided that holding U.S. Treasuries is not where they want to be. Now, I want to counter this because the narrative is like, oh my God, China doesn't want to have treasuries. That's a big problem. It's not. Foreign holders of treasuries are like this. Okay, the United States owns treasuries. Mutual funds own treasuries, pension funds, insurance funds, the Federal Reserve, intergovernmental debt. If you look at the percentage, the actual percentage of U.S. treasuries are 36, 37 trillion outstanding that's held by foreign governments, it's 20, 25% tops. The vast majority of U.S. treasuries are held by...
the largest holder is what? Japan, and then China. And Japan they hold less than $1 trillion. China, I think, is about $500 billion now. And so, yeah, it's probably only 10%.
U.S. individuals, institutions, the government. Okay, China owns like 700-800 billion, right? I mean, the Federal Reserve has rolled off over $2 trillion in treasuries, and like we could absorb all of China and Russia's, and we could absorb all those treasuries easily. So a lot of people talk about, oh, well, China's going to. And I'll tell you another thing. If you look at the foreign tick data of who owns treasuries, you see this really big weird thing, which is like Cayman Islands own tons of treasury. A lot of people assume two things. One, they think it's hedge funds that are located there offshore. The other thing they assume is, and I've talked about this before, is that the Kingdom of Saudi Arabia did not want everybody to know exactly how much treasuries they held. They worried about being deposed. And so the King of Saudi Arabia put a lot of his treasuries in the Caymans to essentially keep that shielded should anything happen to his family and they need to go into exile. I think there's a third reason why the Caymans might own a lot of treasuries. And I think it could be CIA front companies. You know, in other words, Treasury, like I have a saying, all is fair in love, war, and U.S. Treasury management. So,
well, also think about the Panama Papers and how many just rich folks from all over the world, a lot from Europe. You know, they probably have money in the Cayman Islands, and they are owning a lot of U.S. Treasuries in general. So it doesn't have to be CIA, but could be. I'm sure there's some of that.
Like, I wouldn't be surprised if there's a CIA front as hedge funds in the Caymans that they see treasuries get to a level they don't like and they buy it. And it's like, you know, this is the CIA. I mean, this is the federal government. This is national security. So this is all fiat. This is not gold. There's no way to check it. Like, if the president authorized the Department of Defense to do a secret DOD or CIA operation, feed in through front banks, you know, bogus balances on balance sheets, so it looks like you have the currency in your zeros and ones on the computer, and go out and support the treasury market, like, who's to stop them from doing that? So, I mean, I think there's so much stuff that goes on in finance that when people start predicting that we're heading for a collapse, and you
Well, who's to stop them from doing that? The Federal Reserve is supposed to be the regulator, and you also have things like FinCEN and stuff. But yeah, I understand what he's saying. I don't think for that reason, I don't think it could be as big as what he's implying here. You could have small operations.
bills are going to explode. It's like, don't you think that maybe the CIA might have something to say about you? Do you think that's possible? Or are you so naive that you think the US government is just going to let the bond market trade freely?
Yeah. Well, I mean, that's a great point. And
It always goes back to some sort of manipulation and control or conspiracy theories. I'm not a conspiracy theorist at all. I mean, collusion breaks down. And so you're not going to be able to do all this stuff for a very long period of time and have some major global conspiracy of trying to control the markets. That's not, I don't think that can
because you got to think the Pentagon's wargaming national security. Part of that national security is financial security. Like going back to this chart and really pulling on the thread of the sort of fork in the road that you were describing of we could go towards some very volatile kinetic war, economic war, whatever it may be, or avoid World War III. Maybe that's what China is doing here, just signaling like, hey, we have the gold. We're going to exert our influence over spot and futures gold markets by registering our bullion at the Shanghai Gold Exchange. And basically just as like a geopolitical signal, like, hey, let's get to the table and negotiate like peaceful trade deals or something like that.
Yeah, I mean, what this is, and I credit guys like Luke Groman for being way ahead on this, is like China says, okay, to Saudi Arabia, we want to buy gold, you want to buy some of our, or we want to buy oil, you want to buy some of our stuff, but they have a closed capital account on the yuan, their currency. So what they say is what we're going to do is we're going to buy, let's say, $100 billion worth of oil. We'll send you $100 billion worth of yuan. Now, over the course of the next year, you might want to buy $60 billion or 60 billion yuan or whatever from China. And you're left with these yuan that you don't want. What you can do is you can go to the Shanghai Gold Exchange and you can take those yuan and you can get bullion and you can bring it back to Riyadh. And this is what we did with Saudi Arabia in the 70s. Before 71, we used to fly, jet planes full of gold bullion into Riyadh every month, to pay for our oil. Like the Saudis wanted the gold, right? And the USD was convertible by $5 an ounce. So we used to fly gold into Riyadh. And now I think the Chinese are flying gold into Riyadh. They're just not doing it through Beijing. They're doing it through the Shanghai Gold Exchange.
So freaks, this was brought to you by our good friends at Obscura. Obscura is the first VPN that can't log your activity by design instead of TFTC.
Yeah, and then you had, like I told you before, my focus has been on China the last couple of days. I'm actually recording with Peter Alexander tomorrow. Has been living in China for a few decades and he's a Westerner living in China and has his I don't even know it's theory. He's just telling people that the whole perception of China, how it operates and what their ultimate goals are is completely wrong, particularly in Western circles with the pundits. And so I'm excited for that conversation, but bringing it back.
What's the thrust of how the pundits are wrong?
Mainly just a misunderstanding of cultural dynamics, like what China's ultimate goal is, like viewing China as a nation state. Sort of the show notes he sent me is like we're viewing China as a nation state when it's a society, and when you're trying to work within this Western mental framework of nation state sort of negotiations, like that's not how China views things, and I think that's how we end up in these situations where it seems like we're speaking past each other. Many times.
That's smart. So, I agree. And I do think there's a difference in China. I think China, there is this Western-Eastern divide. I majored in philosophy as an undergrad, and, their Western philosophy has a certain thrust to it. And Eastern philosophy is different. The Eastern mind is different. And it's sophisticated in its own way, as is the Western mind. But it almost has different first principles. And so sometimes when Western leaders look at China and try to analyze it through their first principles, they kind of miss the boat because it's a little bit. A lot of people think the Great Wall of China was built to keep invaders out. It was built to keep the population in. So China historically is actually, essentially a fiefdom of dominated groups. So it's not like one people ethnically, and everybody knows there's two major languages. Mandarin. Like essentially, there's a elite in China that has dominated different areas and brought them in under their empire. And historically, China has wanted to keep complete dominance over whatever that empire is. And that was why they built the Great Wall, was to say, look, we're really not interested in the outside world. We want to have complete dominion over these internal groups that we dominate. And so it is a little bit of a different mindset.
That's the second time I've heard that theory in a couple weeks. I don't
kind
know.
of like a British Empire type mindset. So I think that'll be a fascinating conversation I'd love to hear. I'm not a China expert, but I know a little bit about Chinese history and how that country kind of came to be and what it is. They also love precious metals, just like India does. And they love silver too. At one point, silver traded 1-for-1. There's this huge arbitrage, silver, gold, bees in Spanish, Europe, China. Like, they mine silver in South America, ship it to China, get it 1-for-1 for gold, move it back to South America, and then back over to Europe. And, precious metals, I mean, they've just been a part of this for so long. And it's like, I mean, people got to realize, like, this whole fiat thing, like, I was born in 75. Like 71 is when we went off of gold, right? Like, so basically you have from like long before Jesus Christ existed until a couple of years before I was born, gold and silver. And then you have this short little period, essentially my lifespan, where gold and silver are money. And what you're seeing is that gold and silver are money again. And that's just happening. And that's why gold is going to blow out. I saw like somebody on CNBC yesterday showing a chart, like maybe gold's hitting a peak because the copper gold ratio. Look, gold's going to go up relative to every other commodity. Gold's going to go up relative to copper. It's going to go up to everything because it's becoming money again. Gold should be the same as platinum. Gold should be less than platinum. Platinum is a rarer metal. Platinum is, a higher, denser metal. But gold is the monetary metal. So when people talk about Bitcoin, and this is where gold and Bitcoin are the exact same, it's about the belief, in a sense, that this is money. Because it's not like gold is some special metal. Like platinum, like I said, it's less abundant in the Earth's crust. There's been less platinum ever mined. Platinum is much more rare than gold, yet it trades at less than half of the value. Most of gold's value is this monetary premium that people assign to it. Bitcoin is the new gold in that sense, but gold with a different set of stripes, a different drivers of, movements and different things. It's kind of a next gen gold that, could very well be in place for another 1,000 years. I mean, we will see. But I think that like there's only two. In my opinion, there's only two stores of value right now. There's gold and there's Bitcoin. And that's it. And Ether can make its moves and, but Ether ultimately the case for Ether, even that Tom Lee makes, is this is a utilitarian case that Ether is going to drive stuff. Maybe it's Solana drives stuff better, and then Ether is done. The beauty of Bitcoin, the beauty of gold is the case is simply that this is money. This is what is value. It's not about how can we power the best, quickest transaction mechanisms. I'd love to see Bitcoin more involved in transaction mechanisms, but that's not what's driving Bitcoin's value. What's driving Bitcoin's value is it's the first, the ultimate, the decentralized, the cryptocurrency that represents store of value in the same way that gold is the precious metal, even though it's less precious than platinum, even though, silver is more ubiquitous and easier to transact. Like all these things are there to threaten gold, but gold is gold, Bitcoin's Bitcoin. They are the two stores of value. In the long run, like that's where you want to be. That's an anchor in my portfolio. And then I trade around it with all these other viewpoints. But like nothing's going to change to the fiat debasement narrative.
Sup, freaks? Guess what?
Okay, I agree with what he said there, but I look at it as evolution, right? So the last 75 years has been an aberration, but it's because that's what people chose. We were in a high trust environment, and people chose that. The elasticity was a very good bonus because inflation could fuel growth and productivity gains. And now as we are ending this story and we're going into deglobalization, depopulation, we're going to go into deflation, and people are going to naturally choose sound money again. So I agree with what he pretty much what he laid out there. I mean, there's reasons why gold was chosen over platinum, but Bitcoin is just so far superior. And I don't think that gold is going to have as big of a rally as he says. I think it could go up, say, another 50% over the next couple 3, 4, 5 years or something, but Bitcoin is going to go up way, way more. 10 add a zero 10 times. So that's what I would say to that. I only have a few more minutes, guys, and then we're going to call it quits.
Yeah, and I think something you said there is very prescient. Something particularly Americans overlook is that China's been around for millennia. The United States as a country, we're about to have our 250th birthday next year. And not that I'm a China expert by any means, but
I think it's very interesting because, going back 15 years, you'll start when the Thucydides trap came out, they were using the exact opposite argument. They're saying China is the new kid on the block, America is the old kid on the block, and China is the rising power, and the U.S. is the declining power. But really, it's exactly what Marty said, and I pointed this out in my Thucydides trap debunking from years ago, that it's actually the opposite. China is the old one, and the U.S. is still the up-and-coming one. Okay, if you're going to use a Thucydides trap, which I don't even think is a real thing. So, no, and I've done a lot of research just recently in the last few weeks on China because I wrote this post. If you go back to the website, this post here, rethinking the economic center of gravity, and I compared, different times. I did a one-to-one comparison at the time. And here is, we're always told that China is so great. See, China is like 30% and India is like 40% of GDP. But here is this image. So this is pretty much the same century. Rome, the Parthenon, and China and their tombs that they were building. See the difference? I just don't think that China was ever a huge economic powerhouse just because of population, perhaps. But you don't see anything like this in China anywhere. I mean, that's surviving. There's still a working aqueduct in Rome. This is from about I think around 200 BC. Is that what I said? Yeah, 2nd century BC. This is what was going on in the West, these sculptures. And this is what was going on in China. These are terracotta. So they're made out of clay, fired clay. And I went back and I watched a documentary on the terracotta warriors. And it's kind of, they're made out to be some awe-inspiring, huge thing, right? But pretty much everything on here is from a mold. So all of their legs, there's probably a couple variations of different legs, but they had like maybe 8 to 10 different teams, and they were just making these parts in molds and then putting them together. Each face is, they say, slightly different. I don't know. It could be that there's 100 different faces and they just reuse those 100 faces a bunch of times or something like that. But many of them are broken because it's pottery and you can't even tell. But this is just made from molds. Okay, this is like technology from the year 1000 BC, just done on a grand scale. But really, it doesn't have to be that grand. Let's say there's 10,000 warriors, and it takes a team of 2 or 3 guys you could make 1 or 2 a day. I mean, how many teams do you need? There's all these stories about ancient China about how the 100,000, or no, what was it? For the Grand Canal, they said it was like 10 million people or something. And I used ChatGPT. I said, okay, well, let's say how much earth can one guy move, by himself? Okay, so how big is the Grand Canal? If we say it's 25, let's say the average canal is 25 yards wide, 2 yards deep, that amount of material, and it's I don't know, say I probably did it in meters, all in meters, but it's 20,000 kilometers long. So how much earth is that to move? And I said, okay, well, if one man can do this much in a day, how many man days does it take? How many man years? And it's something like 20 years with 20,000 people or something like that. It's not 5 million. If you'd had 5 million, each dude would come there and take one shovel full, work for one day maybe, and the Grand Canal would be built in a year. No, it's a long-term process that probably had about maybe 20,000, maybe 50,000 people working on it, but not 5 million. It's ridiculous. So all of these accounts from ancient China are vastly, vastly overrated. And so if you think about that and now think about modern China, they were built off of foreign direct investment, Western expertise. The Western companies went in there and built the factories, got them going. And now they don't even do like a lot of the fabrication that's done in other countries with lower cost labor. They do just the bulk stuff, right? Bulk comes from China. And that's not a way to build a thriving hegemon, so their economic model is over. And all of these people like Marty and this Mel guy, they think that China has some bright future. Well, China does not have a bright future, guys. It's on the decline. I'm not as radical as Peter Zion, who thinks that China will disappear and all this stuff. I think they'll probably break apart and they'll have a warring states period, just like as their history goes. Their history of being a combined power or being a unified country has pretty much always come from outside. So you had the Mongols unified. I mean, their earliest kingdoms, yeah, they were the natives that unified, but those rarely lasted. But you have a lot of periods, at least maybe say in the last 1,500 years, all of those times of unification have come from outside. The Manchurians coming down, the Mongols coming down. Those are foreign dynasties. And so I just think they're going to have another warring states period. Their economy is crap. The reason why they're selling their treasuries and trying to do something here with gold is a bad sign. It's not a sign of a show of power or anything. They're trying to convince you that it's a show of power. All their fleet that they're building is very similar to the tofu drag construction. So a lot of their buildings are falling apart that they just built because they use substandard rebar or substandard concrete or whatever. And these buildings, you can just grab a pillar and the concrete just breaks up in your hand because their goal is to build it. That's all, right? Same with the fleets of all the ships. They pump out all these ships and the quality is not that great. I'll have to look up some sources for that, but the quality of their ships, I mean, they had some submarine accident, so they're pumping out all these submarines, and their submarine just sprung a leak and sank right in the middle of the harbor that it was in. And so, yeah, these things aren't built as well. Plus, they have no naval doctrine, which I've talked about too. They've never won like a naval battle. They've won battles, waterborne battles on rivers, but they've never won they've never had a blue ocean navy that's won a battle. So, okay, let's continue. Just a few more minutes. What time is it? 5:01. Okay, 2 more minutes.
From what I can tell, their culture, as we described, is very different and very steeped in like history, and dynastic history specifically. They think in centuries, not quarters, like we do over here in the United States. And so, your point that China's just reverting to a monetary standard that existed for most of its existence.
They think in 5-year plans, Marty. They're communists and they have 5-year plans.
Doesn't make sense.
Yeah. And I mean, China, they have what they call the century of humiliation, which is essentially where they were dominated by the British, the opium. All this stuff. They don't want to go back there. I think you can look at Germany and you see how Germany, out of all major European countries, they have the lowest debt to GDP. Like the German people are scarred by the Weimar Republic and the hyperinflation. The Chinese people are scarred by this humiliation of, being dominated by some small island off the coast of Europe called Britain.
And what's happening to Germany? They got rid of all of their nuclear power plants. They're completely dependent on outside energy sources. They're losing their industry like crazy. They just because of their debt to GDP is being handled doesn't mean you can't run your economy into the ground.
And so they're scarred by that. And their main thing is like, we're never going to let this happen again. And I actually think that the main driver of Chinese military buildup is like, they just want to dominate their region. The thing is that the United States does not want China to be an Asian hegemon. Like after World War II, we defeated the Japanese. We were the Asian hegemon. We were and still are the European hegemon. It took us a while in Europe because we had to overcome the Soviet Union, but eventually we got there. And in Asia, we've been the hegemon since 1945, since we dropped the bombs. So we've been in charge of Asia. And like I think ultimately Americans can get comfortable with living in a peaceful world, having a higher standard of living, but this might be heresy. Like, let China be the Asian hegemon. You know, like why do we need to control Asia? Like why do we need to be the dominant force in the Philippines and Indonesia? Like, I know there are corporate interests that want that, but me as as an American, like I don't want that. I don't feel I need that. I don't feel I need America to be the Asian hegemon. And I don't think that there's any threat to the United States from China.
That's a very American thing, right? So America is a very non-interventionist country, isolationist country. World War II, World War I, those were rare, and it took a lot. It took a lot to get us into World War I and World War II. And we've been kind of so far a willing global hegemon from the Cold War and up to today, but that time is over. And yes, we are more isolationist. So his comments right here are very American. Now, China doesn't think like that. And I'm not a super China expert, but they think they have the mandate under heaven, or the mandate of heaven, and that they are the middle kingdom and they are to control and vassalize the world under the king, under the emperor, under the dynasty, under Xi over there. So yeah, there's definitely different thought processes going on, but what he's saying here is a very American viewpoint. It's just, there's a tinge of irony there. You know, they're saying that they were just talking about how different these places are. Well, yeah, exactly. And you're proving that right now by saying we don't need to be the global hegemon. You think like that because you're American. Chinese don't think that way. Japanese don't think that way.
I don't think like Red Dawn is going to happen, right? And then they're going to send over troops and invade, Tacoma. Like we've got guns in every house. We've got like 10x nuclear weapons that China has. Like we've got an amazing Navy. Like China's not going to invade and take over the United States, and neither is Russia. So who cares? Let Russia run Europe. What it threatens is the corporate elites. And I think like, to me, like, let's focus on America. Let's focus on the Western Hemisphere. Let's actually bring more of these Latin countries, which Americans seem to get along great with Latinos. I mean, I never mentioned this before, but personally, I speak Spanish. My wife is a Colombian immigrant. I love South America. I love Latinos.
Yeah, it's traditionally been the Monroe Doctrine. This is our hemisphere stuff. Also, what he was saying is business interests. So my view of the world is these factions, okay? And I started developing this when Tom Luongo was talking about Davos Man. Okay, so Davos Man is the globalists, and they are the Marxists. They are the bureaucrats right now. Then you have bankers. Okay, and you can put the large business owners into either one of those groups, really. But I would say they probably fall more into the moneyed class, the bankers. So the people, yes, the people do not have interest in maintaining the global order. Exactly what he's saying. It's a very American thing, because America was a very populous country, and it still is a very populous country. And so the people don't want to do that, but the other two factions do. The Marxists want to have global government under the bureaucracy. Bankers want to have global control through the money. So there's multiple interests keeping America involved. The worst nightmare for these people is for America to become isolationist. They don't want that. That's why they had all these entangling alliances, and they're really trying to keep the U.S. engaged. But I think over the next 12 years or so, it's going to be very, very obvious that the US has withdrawn from the entire world. And that's not good, because most of the growth in population, most of the growth in the economy has come under the hegemony of the United States. And if you remove that hegemony and the peacekeeping and the global policeman force, things are going to explode. So let's end on that doomer note. Let me see if there's any comments from Telegram. I'm not seeing any. Uncle Swan, yeah, about the treasuries being income. Yeah, it's income, but it can be income for someone outside the United States. Yeah, sure. It can be income for everybody. That's why yields going down is it's a hard place to get out of, low yields. And I mean, they're low because the economy sucks. So everyone is there. And there's no better place to put your money. So, all right. All right, guys, that's going to be it for today. Thanks for hanging out. I am going to go live here on a space with Charlene Foderipo at 6 p.m. So join me over there on Twitter for that. I'll share a link in Telegram. And that's it, guys. See you later. Bye.